Gold prices have crashed. Gold prices have crashed. Since 2011, gold has plummeted more than 25%, and the worst may not yet be over. The Profit Strategy newsletter at ETFguide.com warned its subscribers the gold bubble would pop, and it has. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. What happens next in the gold market will shock the entire globe. Join today at ETFguide.com and get a $50 bonus by using promo code SAVE50.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's broadcast, we've got a bull market in QEternity. The Federal Reserve surprises Wall Street, surprises economists, and QE-addicted Wall Street celebrates stocks going higher, gold heading higher. Briefly, we're going to give you some perspective on that. We're also going to get into some of your phone calls. We'll do a little bit of trivia on today's broadcast. We'll also get into some of your emails if you'd like to talk with us about a particular stock, mutual fund, ETF. 877-711-5611 is the number. Give us your first name along with your city, and we will get to you. I also want to share with you on today's broadcast 4 tips for improving your swing. And when I talk about swing, I'm really referring to your ETF investments / trades. So I'm going to give you 4 tips for how to improve your odds of success, some tips, some things that we use on this broadcast, as well as for subscribers of my monthly newsletter at etfguide.com. Again, if you'd like to join us to talk about a particular stock, mutual fund, ETF, if you want to do some rocket surgery with me on a particular company, we can do that. We can look at its performance versus its peers. We can also look at its performance versus the broader market, because after all, isn't that why you're buying an individual stock? So that it could beat the market? And if you do a little bit of rocket surgery, I think you'll be surprised by the actual performance of that stock that you think is so great. Well, let's take a look at the performance. Let's really evaluate it and see how it's doing. We'll do some rocket surgery. 877-711-5611. That is the number. We're here. So the market gets what the market wants. This was the biggest news definitely of this past week. The U.S. Federal Reserve delivered the drugs. The Fed surprising the market. How about all those economists at Bloomberg that were polled? I think there was 65% of them that said that tapering or a scale back of QE or monthly purchases of long-term U.S. Treasuries and mortgage-backed securities would indeed be implemented. And wow, they sure were wrong, weren't they? 65% of them said it would happen, and 100% of them were wrong. Reminds me of something Paul Samuelson said, a Nobel Prize-winning economist. He said, Wall Street's economists, Wall Street's analysts have successfully predicted 9 out of the past 5 recessions. So that pretty much explains why they've been so wrong about so much. Now, although stocks, bonds, and precious metals did get a one-day surge, and boy did they surge, what we later learned very quickly is that one day's performance does not make a trend. And boy did gold investors learn that very quickly. We'll get into a little bit about that, but gold, silver, but the gold mining stocks, silver mining stocks, taking it on the chin the following day. I want to give you an update on this. This, by the way, is one of my top 10 mega investment themes. In fact, it's not just one of my top 10, it's one of my top 3. The great gold crash of 2013. I've been telling you about this. We've been consistent on this, not just recently, but even before this trend really became what it is today. So, gold bugs, call the program. What are you thinking? Let's argue. Let's fight. Is the worst over? and some strategies to help you get your mind right so you can get your money right. 877-711-5611. You can tweet the program live. At Index Show is my Twitter handle. Ron at indexshow.com is my email address if you want to get in touch with me that way. So in thinking about QE and all the things that it has not been able to do, I put together a short list in my just published October newsletter. This is the ETF Profit Strategy newsletter. Yes, the October issue is out, and these are some of the short list of things that I came up with, and just thinking about it logically and intelligently about what the Federal Reserve's aggressive monetary policy, also known as QE, hasn't been able to stop. For example, it hasn't stopped the yield on 10-year U.S. Treasuries from soaring 51% over the past year. It hasn't stopped precious metals from falling into a bear market by more than 25% since 2011. It hasn't stopped mortgage refinancing from crashing 71% since May 3rd. It hasn't stopped nationwide unemployment from being stuck in double digits. Yeah, the August U6 number, the one that the media never refers to, well, because they're out to lunch, is still double digits, 13.7%. QE hasn't been able to stop that, has it? It hasn't been able to stop the U.S. labor force from shrinking to its lowest level since 1978. And it also hasn't stopped 1 out of 8 borrowers in the $1.2 trillion student loan marketplace from defaulting. And yikes, if interest rates keep rising, I can't imagine what that number is going to turn out to be. Right now, it's 1 out of 8 borrowers in default in the student loan marketplace. I mean, if rates start edging above 3%, and I think I told you we're going to have a date with 3% again. We had a date briefly with 3% a couple of weeks ago. Well, we're probably going to dance with that level again. And it's time for you to be ready. It's time for you to understand that these firmly rooted trends have not been able to be reversed by the Federal Reserve's quantitative easing, or QE. So yes, QE lives for another few moments, another few months. They're talking about scaling it back in December. We'll see. One other thing to consider is that if the Federal Reserve, in its infinite wisdom, can surprise financial markets with a continuation of its invasive monetary stimulus, then the opposite must also be true. The Fed can surprise the market by scaling QE back faster and deeper than anyone expects. 877-711-5611 is the number. Please join us. We're here. If you want to talk about a particular stock, mutual fund, investment theme, you want to talk about the Federal Reserve, we'll have my trivia question ready for you in the next segment. We're going to get you involved and test the intellect of this audience. So stay tuned for that. We're also going to give you some tips for specific suggestions, strategies for improving your investment swing. So we got a lot to get into on today's broadcast. Let's give you a quick recap of where the broader markets stand so far in 2013. Now, we've taken a look at the total U.S. stock market, ticker symbol VTI, ahead by a very frothy 22.86%. And we've got a printout, a picture, a word visual of our global equity map. It's in the ETF Profit Strategy newsletter, October issue. And what you'll see is it's a global map showing all of the specific ETFs by country. And you'll notice that the United States and Japan are both ahead by just over 22% year to date, and leading global stock market indexes higher. And can you tell me what those two countries have in common? What the U.S. and Japan has in common? Yes, you guessed right. Those two countries, the Bank of Japan and the Federal Reserve, have central banks that have been the most aggressive participants in their monetary stimulus, and certainly that's been boosting these financial markets, these stocks higher. The risk on trade is on for now, At least that's what the equity market is telling us. We'll get into more. You're listening to the Index Investing Show. 877-711-5611 is the number. I'll be right back after this short break. Go nowhere.
The Index Investing Show with DeLegge.
All right, welcome back to the Index Investing Show. 877-711-5611 is the number. We're here talking the birds and the bees of successful investing. If you'd like to join us and talk about a particular stock, mutual fund, ETF, or investment theme, we can do that. My top mega investment themes thus far of 2013, of course, the great gold crash of 2013. That's number one. Number two, I've got rising interest rates, bond yields surging 49% year to date, the 10-year yield. And you think about it. I mean, let's use our brains here. Even with the Federal Reserve continuing its QE, I mean, it's done that uninterrupted really since 2008. And that still has been not able to stop interest rates from rising as much as they have and as fast as they have. So you tell me, do you think another couple of months is going to really make a difference? Please. So they're going to continue with QE until December before finally deciding to pull back the drugs, the steroids from financial markets. They've created an asset bubble in many places. And so the thing here is that these firmly rooted trends are still in place, even though they took a little bit of a one-day breather when the Fed came out with its announcement that it would continue a QE. Now, coming up in a little bit, we're going to talk about 4 ways to improve your swing. We're talking about how to improve your investment trades with ETFs, as well as those of you that use ETFs for long-term or short-term investment purposes. I have some tips I want to share with you. Now, I think back to that pivotal moment in that classic movie Star Wars. You remember Admiral Akbar? He's in his ship, and they're heading to attack, I believe it's the Death Star, and listen to what he had to say to his warrior friends.
It's a trap! It's a trap! It's a trap!
Yeah, it's a trap! It's a trap! It's a trap! And that so well describes the precious metals market. It's a classic bull trap. And all of these gold bugs, from Peter Schiff to James Turk and all these perma gold bulls, have been total suckers. They've been suckered by this market. A bull trap, by the way, is defined as an inaccurate measure. It's an inaccurate measure that shows a decreasing trend in the price of a stock, a bond, or commodity has reversed itself and is now heading upwards, when in fact the asset will resume its decline. So that's called a bull trap. It's an inaccurate measure. And that's exactly what's been going on in this precious metals market. Now, we had a golden opportunity on September 18th when the Fed came out, announced it would continue its QE, and we saw gold-related assets just jumping, a one-day jump. And it was nothing more than a bull trap. It was a sucker rally. And we used that as an opportunity to make some quick profits. I'm going to share that with you a little bit later in the program. Stay tuned for that. A time-stamped trade to just show you the type of moves that we've been making in this gold market, because we recognize the difference between a legitimate rally and a sucker rally or a bull trap. And it's too bad that more gold investors haven't been able to see this. I mean, it's so plain as daylight that what's going on in this particular market, and it's repeated itself multiple times so far this year. 877-711-5611 is the number. We're here taking a look at some economic news. U.S. housing starts rose almost 1% from July to seasonally adjusted annual rate of 891,000. That's according to the Commerce Department. Still, that was less than the 915,000 being forecasted by economists and below the 5-year high of just over 1 million that U.S. housing starts hit in March. This particular sector, I don't think has fully reflected yet the severity of higher interest rates. And we all, National Home Builders Association, the Home Builder Sentiment Index, still at excessively bullish levels at 58 for the month of September. Now, the peak reading for the Home Builder Sentiment Index was 61 in November of 2005, right before the housing crash, and we're at 58 today. So we're not far off from that peak. And most executives in the mortgage and housing sector continue to brush aside the 49% surge that we've had in the 10-year yield and the 22% surge that we've had in fixed-rate 30-year mortgages from last year's average. What was it last year? Let me go back down to the catacombs and dig through the file and see what 30-year mortgages, fixed-rate mortgages, were last year around this time. Does anybody remember, or do we have such short-term memories we can't recall? We just remember what we want to remember. Well, let me go down to the catacombs. Let's see. It says that we were at 3.66%. That was last year on 30-year fixed-rate mortgages. Today we're at 4.46%, so almost 4.5%. That's a 22% jump. And you listen to these housing executives, these mortgage executives, and all of them basically are like robots, saying the exact same thing. Why higher interest rates don't matter. I mean, their answers are almost invariable. Well, today's mortgage rates are still low compared to historical standards. Yeah. I mean, that's the favorite comeback that they love to use because their PR handlers can't come up with anything better. But the truth is that today's mortgage rates, even though they may be lower compared to historical standards, the economic climate is not what it was years ago. The economic climate today is a very different place. It's a very different place, and we already explained to you some of these things in the first segment about nationwide unemployment still being stuck in double digits. We've got a labor force that has shrunk to its lowest level since 1978. So these are things that you need to be aware of. This is not what it was or what it used to be like before. 877-711-5611 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. We're here talking the birds and the bees of successful investing. Please join us. Let's go to Livermore, Colorado. We got Steve with us. He wants to talk about the student loan asset bubble, $1.2 trillion marketplace. Steve, welcome to the program.
Yeah, good morning. Thanks for having me. I love your show. My question is, I have my daughter. She's going to a college in Colorado, and last year we took out a student loan, and we were able to get a rate at 3.25. This year for the new year, we also had to take out a loan. It's at 3.75. That's with a 1% discount because of my credit score. But I'm a little bit nervous because these rates are variable, and you were discussing the possibility of it going up. And there's no cap on these, and it could go up as high as 15 to 18%. So I'm just kind of looking for a little bit of advice in going forward with these loans.
Yeah, it's a very, very difficult situation. The government, J.P. Morgan Chase, did you see that move, Steve? What they did a couple of weeks ago? Did you catch that news?
I'm sorry, I didn't.
J.P. Morgan Chase is pulling out of this market. They're not going to be participating anymore in originating student loans. So basically what this means is that the government's going to have to do something. They're going to have to come up with some kind of program to help people in your situation. And what it's going to do is it's going to raise the government's liabilities and going to increase the burdens for the rest of society. So these are some of the things that are going on. And right now, I don't have any specific advice for you and your daughter to help you with this. all I can say is hang in there and wait for the government to bail you out. They already bailed out Wall Street, so why wouldn't they bail out the public? Stay with us, Steve.
Okay,
Stay with us. We'll be right back after this short break.
The Index Investing Show with Ron DeLegge.
Have you met Jane Investor? She wants her investments to grow, but she's too busy to bother. In fact, Jane Investor is so busy she didn't realize owning real estate investments in the wrong brokerage account exposed her to unnecessary taxes. She also forgot to roll over her 401k plan because, well, she was too busy. The Profit Strategy newsletter at etfguide.com helps busy people like Jane Investor to stay on top of their investment portfolios. We tell you what to buy, what to sell, and when to do it. It's okay to be busy, but it's not okay to be sloppy with your investments. The Profit Strategy newsletter at etfguide.com will save you time and help you to succeed. Join today and get a $50 bonus by using promo code JANE50. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to etfguide.com to get started and promise yourself to never, ever be too busy to be properly invested.
We're going to do some trivia on today's broadcast. I want to test the intellect of this audience. We've been talking a lot about the Federal Reserve and their decision to continue with quantitative easing uninterrupted. And that took the market by surprise. It took Wall Street by surprise. 65% of economists polled by Bloomberg were expecting the Fed to taper back or scale back on its monthly purchases of U.S. Treasuries along with mortgage-backed securities. That did not happen. So 100% of those 65% were wrong. And it harkens back to what Paul Samuelson said. I love that quote. Wall Street's economists and analysts have accurately predicted 9 out of the past 5 recessions. And I just couldn't, that was just in my mind all week, especially in thinking about just how wrong these economists were. So we let the market be our leading guide. That's what helps us to understand what's really happening, and the market's reaction to what's happening is really noticeable after the day after the Federal Reserve made its announcement. Of course, it got a little bit of a jolt on the upside. We saw gold, we saw stocks, we saw bonds moving higher all in unison. And then all these pundits came out and said, oh, the worst is over for gold. Yeah, gold's going to go to the moon now. Yeah, precious metals are going to the moon. Yeah, this quantitative easing by the Fed, man, this is, Peter Schiff and his hordes of brainwashed followers just coming out and spewing this completely inaccurate advice. I mean, this has been nothing but a sucker rally. It's been a bull trap. And I want to share with you one particular move that we made this past week. We capitalized on all these suckers and the wrong moves that they were making. I want to compare and contrast what they did and what we did. I'll share that with you in a minute. I want to get into some of your emails right now. Dear Ron, I listen to the podcast of your show every week. I love the program. I have a question for you. I really like to follow the ETF fund flow numbers and the assets under management. What website tool do you recommend, any possible free ones that I can use to see the numbers on a chart, just like the price volume charts? Signed, Jagdish. And my best suggestion for that, I personally don't really follow very closely the fund flow numbers just because they're lagging. They're lagging. They don't really tell us what's going to happen or give us any future indicators, but they kind of tell us what already happened. X amount of money went into a particular ETF or went out of a particular ETF or a particular industry sector or a particular asset class. So I would check Morningstar And I would also check Stock Charts, which has excellent charts that we use at etfguide.com, outstanding charts, among the best out there. And they've got all kinds of data that, and that particular data set of fund flows into ETFs in and out might be available in the form of a chart. So check those two sources out, stockcharts.com or Morningstar. Also got an email from Paul asking if I got dusted, and Paul is referring to the one-day collapse. I think it was on September 18th of ticker symbol DUST, which aims for triple daily opposite performance. That's the direction daily gold miners bear 3X shares, DUST. And Paul asked, did I get dusted on that 27% collapse? And I'm pleased to say I did not, Paul. I did not have a position in that particular ETF. The ETF Guide Profit Strategy newsletter did not have a position. Now, this is an ETF that we've successfully had multiple trade setups. And I think only once this year we had a trade that did not work out, and it was really a break even. The past couple times, though, DUST, we've hit it. We've hit the jackpot. And we did again on 9/19. At September 19th, we bought the Direction Daily Gold Miner Bear 3X shares. We issued an alert to subscribers to buy DUST at $24.60 a share. Now, we also told readers to put a stop loss on that in case it swung in the opposite direction and went against us. Thankfully, it did not. So what happened after that one-day 27% collapse in DUST? What happened? Well, it rose on September 19th. It rose again on September 20th. And we sold our DUST position for a two-day 16.5% blended gain or blended profit. Now, again, DUST aims for triple daily opposite performance of gold mining stocks. It was a great trade. We capitalized on that one-day collapse because, well, sentiment was overly bullish surrounding gold and gold miners. And while they proclaimed higher prices were ahead, we took an opposite perspective, and we made money on that. We also had a tandem trade. Those of you that like to trade options, we had a position in the gold miner ETF October 25 put options, GDX. We told subscribers to buy GDX put options at $40 a contract. We sold them for a two-day gain of 68%. Shazam. That's called making money. And it's called also ignoring what these gold pundits and what these analysts and what these Wall Street talking heads are saying. Because every single one of them was out there saying, oh, gold's going to the moon. Gold miner stocks are going up. And every single one of them was completely wrong. So ignore their poisonous advice because it will destroy your net worth. 877-711-5611 is the number. We're here. We're talking the birds and the bees of successful investing. Toward the tail end of the last segment, we had a caller from Livermore, Colorado. We were talking about the student loans, and he currently has a variable loan of 3.25%, which is pretty good. A 3.25% variable loan, and he was asking about, well, what should he do? You know, if rates head higher, I mean, that rate is also going to head higher. And if he converts to fixed, it won't cost him anything. But the problem is the fixed rate is 8%. Just incredible. I mean, you want to talk about highway robbery? How can you have such a large discrepancy between the variable rate and a fixed rate on a student loan? I didn't realize it was that insane. I mean, it's like dealing with the mob. Actually, there's an idea. You might want to ask the mafia to see if they've got a cheaper loan compared to your local bank, because that's what it seems like. But my best advice to him was to try to pay down as much as he can before this surge in rates really gets out of control. And I don't know how much longer we've got. Maybe we've got another, 1 or 2 year window before rates really start to head higher. I mean, they've already gone up. The 10-year yield, 49% since the beginning of the year. And the Fed's QE hasn't been able to really stop that or slow that down. So now that QE very soon will be slowing, I mean, what's that going to mean for yields? I mean, we have a trend change here. We've had a trend change here. I've sung the song to you before. I'm not going to sing it to you again. But that's just my quick take on it. 877-711-5611. We're here. If you want to talk about a particular stock, mutual fund, ETF, I want to get you 4 tips to improve your swing. That coming up. I also need to get you caught up on what some of the industry sectors within the S&P 500 are doing. Also, what U.S. city does not have a Federal Reserve branch? Is it A, Chicago, B, Atlanta, C, Tampa, or D, San Francisco? Call the program, 877-711-5611. Be here or be nowhere.
The Index Investing Show with DeLegge.
All right, I feel like giving away a signed copy of my book, Gents with No Sense, a closer look at Wall Street, its customers, financial regulators, and the media. Be forewarned, ladies and gentlemen. This is a 4.5-star reader-rated book. 4.5 stars out of 5 stars at Amazon.com. Gents with No Sense, a closer look at Wall Street, its customers, financial regulators, and the media. It is available as a paperback as well as a Kindle ebook. And the question is, the trivia question is, which U.S. city does not have a Federal Reserve branch? Is it A, Chicago, B, Atlanta, C, Tampa, or D, San Francisco? If you know the answer, you'll get a signed copy of my book, Gents with No Sense. First caller, 877-711-5611. Again, 877-711-5611. Which U.S. city does not have a Federal Reserve branch? Is it A, Chicago, B, Atlanta, C, Tampa, or D, San Francisco? So taking a look at some of the top performing S&P 500 industry sectors thus far in 2013, the leaders continue to lead. And the number one performing sector within the S&P is the healthcare sector. Ticker symbol XLV tracks that particular category, ahead by a sizzling 30.38%. So a very, very nice return there for healthcare stocks. And really, I mean, take a look at those biotechs. The biotech sector is just on fire, and that's been fueling some of the gains in this particular sector. And then, of course, you've got hospital stocks in there, hospital healthcare device makers, pharmaceutical companies. But we see the healthcare sector outperforming the broader S&P 500 by roughly 9%. So it's been a pretty large margin of victory there for healthcare stocks. Also, we've got the financial sector doing pretty good. XLF ahead by 25.5%. We've also got industrial stocks above 25%. So those are the some of the top sectors. Oh, I almost missed it. XLY, consumer discretionary stocks are performing just as good, up 29%. So you got right there 4 industry sectors within the S&P 500 posting gains between 25 to 30%. And all of those sectors, by the way, outperforming the broader S&P 500. Let's go to the phone lines. The question was, what was the question? Which U.S. city does not have a Federal Reserve branch? Is it A, Chicago? Is it B, Atlanta? Is it C, Tampa? Or D, San Francisco? Let's go to Randall in San Francisco. What is the answer?
Good morning. Tampa.
Tampa! Good answer. How did you know that?
Process of elimination.
The process of elimination. Good job, Randall. And, of course, Randall's from San Francisco, which does, by the way...
country.
What's that?
Janet Yellen country here.
That's right. She is from there, isn't she?
That's right.
Well, I don't know if that's going to help you guys, but you do have a Federal Reserve in San Francisco, and the answer is correct, Randall. We appreciate that call, and stay on the line. You're going to get a signed copy of my book, Gents with No Sense, A Closer Look at Wall Street. And let's go to the phone lines. We've got John with us. John is also in San Francisco. You still there, John?
Yes, I'm still here. The answer is Tampa.
You're such a cheater, John. That's just what Randall said.
Oh, really?
Yeah, don't you listen?
Yeah.
I know. Well, anyway, stay on the line, John. I'm feeling extra generous. You'll get a copy of Gents with No Sense, too. Hopefully you're enjoying the show. How's the weather up there in San Francisco, by the way?
It's great. It was really raining a lot yesterday, but blue skies today.
Excellent. That's what I like to hear. So stay on the line. You get a signed copy of Gents with No Sense, A Closer Look at Wall Street. And, of course, anywhere on the left coast, and our show is based in San Diego, I always joke, it's the same weather every single day, 60 degrees with a chance of earthquake. That pretty much rounds up the plight of Californians. 877-711-5611 is the number. Ron at indexshow.com is the email address. My Twitter handle, @indexshow. If you ever miss our regular weekly broadcast, which is brought to you live, you can pick up our podcast, which is offered at itunes.com. You just search under the Index Investing Show. You can also pick up the program. We now publish on YouTube, so you can listen to the show there. And on any electronic device that you've got, if you got an iPhone, if you've got an Android, whatever, if it has MP3 capability, you can listen to the broadcast. So I want to give you some tips. 4 tips for improving your swing. You know, when you think about it, increasing your odds of investing success with ETFs, or really anything, it doesn't happen by accident. So let's quickly examine just a few strategies that I think that can really help you. We use this at etfguide.com to help increase and improve our own batting average. And I'm pleased to say that through the middle of the year, 78% of our weekly ETF picks have turned a profit. And not all of them have been big profits, but some of them have. We just aim to get a walk or a single. That's what we aim for. Sometimes we get a grand slam, sometimes we get a triple. But the point here is we want to increase our batting average. We want to increase our winning ratio. That's what we're really after. We're after wins. And if we can pile up the victories, well, then the profits will follow. So tip number 1 is to protect your capital. We always use stop-loss orders on all new ETF positions. Now, with the leveraged 2X and 3X ETFs, we always allow a little bit more leeway for a stop-loss, usually up to about 10%, because of the expected larger daily price swings that you get with those types of ETFs. Unleveraged funds generally can have a 5 to 7% stop loss, depending on the asset class. Tip number 2, stick to your guns. When a stop loss is triggered, it will do exactly what it's designed to do. It's going to get you out. Now, we don't second guess ourselves or double down on a losing trade or a losing investment. When it hits the stop loss, we're out. If the trade doesn't work out, if the investment doesn't work out, you cut your losses and you move on. You don't be a head case or a basket case and continue holding an investment that you can buy perhaps later at a lower price. So stick to your guns. When a stop loss is triggered, you get out. Third step, raise your stops. This is something that so many traders and investors forget. Increasing your trailing stop loss when the price of your ETF increases is an absolute must. It will allow you to protect your paper profits. When a trailing stop, while a trailing stop has all the safety features of a regular stop loss order, like all things in life, it's never 100% guaranteed. If an ETF's price gaps down below your trailing stop, the order is automatically converted into a market order and will be filled at a lower price. So that's a possibility, but despite that, I still advocate the habit of raising your trailing stop loss order. It will protect It's designed to protect your profits. You don't want them to just evaporate. So raise your stops, get into the habit of doing that. And finally, my final tip for improving your swing, increasing the odds of your investing/trading success with ETFs is don't be greedy. If you're fortunate to make a quick 10% gain, for example, don't lament the fact that you could have made a 15% gain or 20% gain or something higher. Don't do that. The market's a stingy place. Enjoy what you made. Relish it. Enjoy it. Celebrate it. Don't be a greedy slob. So there you go. My 4 tips for improving your swing. That, by the way, is an excerpt from the October ETF Profit Strategy newsletter, which has just been published. I've also got a picture of Admiral Akbar from Star Wars in the newsletter, along with charts on all the major asset classes and top yielding ETFs, top performing sectors, onward and so forth. But remember his words, folks, and remember it as it relates to the gold market. It's a trap. It's a trap. It's a bull market or bull trap. That's what it is. Well, that does it for another episode of the Index Investing Show. It's been great having you with us. Please join us again. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.